If you own a home, are thinking about buying one, or ever plan to sell one, there's a tax system quietly running in the background that most people never fully understand. It shows up on your mortgage statement. It shows up when you sell. It even shows up when you inherit a house from a parent. And in 2026, several of the rules around it just changed in a big way. By the end of this video, you'll understand exactly how real estate taxes work. Property taxes, the deductions you're actually allowed to take, what happens when you sell, and what happens if you own rental property. No jargon, no fear-mongering, just how it actually works. The video is divided into 6 sections. Section 1. What property tax actually is. Let's start at the most basic level. Property tax. Every year, your local government, usually your county or municipality, assesses the value of your home. That's called the assessed value, and it's not always the same as what your home would actually sell for on the market. Your local tax authority then applies a tax rate, sometimes called a mill rate, to that assessed value. The result is your annual property tax bill. This money doesn't go to the federal government at all. It funds local services, schools, roads, police and fire departments, libraries. That's why property tax rates vary so much depending on where you live. Some states have property tax rates under 0.5%. Others are well over 2%. Same house, wildly different tax bill, just because of location. If you have a mortgage, there's a good chance you don't even pay this bill directly. Most lenders collect a portion of your estimated property tax every month as part of your mortgage payment, hold it in something called an escrow account, and pay the tax authority on your behalf when the bill comes due. If you own your home outright, you pay the tax authority directly, usually once or twice a year. Here's the first thing most homeowners get wrong. They assume what they see in escrow is what gets deducted on their taxes. It's not. You can only deduct what was actually paid to the tax authority during the year, not what you deposited into escrow. That mismatch trips up a lot of people at tax time. Section 2, the SALT deduction, and why 2026 is different. Now here's where it gets interesting, because the rules change significantly starting in 2025, and they're still in effect for 2026. Property tax falls under something called the SALT deduction, state and local tax deduction. SALT bundles together the state and local income tax you pay, your property tax, and in some cases, personal property tax, into one deductible category, but only if you itemize your deductions instead of taking the standard deduction. For years, going back to 2018, there was a hard cap on this. You could only deduct $10,000 total in SALT, no matter how much you actually paid. If you lived in a high-tax state and paid $25,000 in state income tax plus $15,000 in property tax, you still could only deduct $10,000 combined. That made itemizing pointless for a lot of homeowners because the standard deduction was often worth more anyway. That changed with new legislation. For 2025, the SALT cap jumped from $10,000 up to $40,000. For 2026, it increased again slightly to $40,400. This is scheduled to keep increasing by about 1% each year through 2029, before reverting back down to the original $10,000 cap starting in 2030. So right now, homeowners are in a temporary window with a much higher deduction ceiling. There's a catch, though. This higher cap phases out for higher earners. If your modified adjusted gross income is above $500,500 for 2026, your SALT cap starts shrinking. For every dollar of income above that threshold, your cap is reduced by 30 cents. It never drops below $10,000, no matter how high your income is, but the full $40,400 benefit is really aimed at middle and upper middle income homeowners, not the highest earners. Now, one important nuance that catches a lot of people off guard. This SALT cap only applies to property that's for your personal use, your primary residence, or a vacation home you're not renting out. If you own rental or investment real estate, property tax on that property isn't subject to the SALT cap at all. It's simply deducted as a normal business expense on a different tax form entirely. We'll come back to that in the rental property section. Section 3, mortgage interest deduction. The other major deduction tied to owning a home is mortgage interest. If you have a mortgage, the interest you pay on it is deductible, but again, only if you itemize instead of taking the standard deduction. As of the current rules, you can deduct interest on mortgage debt up to $750,000 for loans taken out after December 16, 2017. If your mortgage originated before that date, the older, higher limit of $1 million still applies to you. Here's something that used to be temporary, but isn't anymore. This $750,000 limit was originally set to expire, but recent legislation made it permanent. So homeowners now have long-term certainty on this number, instead of wondering if it'll change again in a few years. There's also a smaller but genuinely useful change starting in 2026. Private mortgage insurance, or PMI, the extra insurance cost you pay if your down payment was under 20%, is now treated the same as mortgage interest for deduction purposes. If you've been paying PMI and assumed it was just a sunk cost, that's no longer entirely true. Now here's the real question every homeowner should actually be asking. Should you itemize at all? The standard deduction for a married couple filing jointly in 2026 is a little over $29,000. So you add up your mortgage interest, your property tax up to the SALT cap, and any other itemized deductions like charitable giving. If that total is higher than the standard deduction, itemizing saves you money. If it's lower, you're better off just taking the standard deduction and not bothering with the paperwork. A lot of homeowners assume they should always itemize because they have a mortgage. But if your interest and property tax combined don't clear that standard deduction line, itemizing gains you nothing. Section 4. Selling your home. Capital gains tax. This is the part most people don't think about until they're actually selling, and it's often the part with the biggest dollar impact. When you sell your home for more than you paid for it, that profit is technically a capital gain, and capital gains are taxable. But homeowners get a significant break here called the Section 121 exclusion. If you've owned and lived in the home as your primary residence for at least 2 of the last 5 years, you can exclude up to $250,000 of profit from capital gains tax if you're single, or up to $500,000 if you're married filing jointly. For the huge majority of home sales in the country, this exclusion completely wipes out any capital gains tax owed. You only start owing tax once your profit exceeds that threshold. Here's a detail that can genuinely save you thousands of dollars, and almost nobody tracks it properly. Your profit isn't just sale price minus purchase price. It's sale price minus your cost basis. And your cost basis includes your original purchase price, plus certain closing costs from when you bought, plus the cost of capital improvements you made while you owned the home. This is where the difference between a repair and an improvement really matters. Fixing a leaky faucet or patching a section of roof is a repair. It doesn't add to your cost basis. Replacing the entire roof, finishing a basement, adding a bathroom, those are improvements and they get added to your basis. That means when you sell, your taxable profit is smaller because the money you spent improving the home effectively reduces the gain. Practical example. Say you bought a home for $300,000, spent $65,000 on qualifying improvements over the years, and sold it for $450,000. Instead of the IRS looking at $150,000 of profit, your adjusted cost basis is $365,000, so your actual taxable gain is $85,000. If you're married filing jointly, that entire $85,000 falls well under the $500,000 exclusion, meaning you owe zero capital gains tax on the sale. But if you never tracked those improvement costs and didn't have records, you might not even know you qualify for that lower number. The lesson here, keep every receipt for home improvements for as long as you own the property. It costs you nothing to save them, and it can save you real money the day you sell. Section 5. Rental and investment property. Everything we've covered so far applies to your personal home. Rental and investment property plays by a different set of rules entirely, generally more favorable ones because the IRS treats it as a business. First, remember what we mentioned earlier. Property tax on a rental property isn't limited by the SALT cap at all. It goes on a completely different form, Schedule E, as a normal, fully deductible business expense. A landlord paying $20,000 a year in property tax across a few rental properties deducts the entire amount, no ceiling, regardless of what's happening with their personal SALT cap. Second, rental property comes with a deduction homeowners don't get, depreciation. Even though real estate often increases in value over time, the IRS lets you deduct a portion of the building's value every year, spread out over 27.5 years for residential rental property, as if it were wearing out. This is a paper deduction. You're not actually spending that money each year, but it reduces your taxable rental income significantly, sometimes down to zero, even when the property is cash flow positive. Third, nearly every expense connected to running the rental is deductible. Mortgage interest, insurance, repairs, property management fees, even travel costs directly related to managing the property. This is fundamentally different from owning your personal home, where most expenses aren't deductible at all. One important term you'll hear a lot in real estate investing circles, the 1031 exchange. This allows an investor who sells one investment property to defer paying capital gains tax entirely, as long as they reinvest the proceeds into another like-kind investment property within a specific time window. It doesn't eliminate the tax forever, it defers it, but serious real estate investors use this repeatedly to grow a portfolio without a tax bill eating into their capital every time they sell. Section 6. Inheriting property. Last piece, and it's one that surprises a lot of people. What happens tax-wise when you inherit a house? If you inherit property rather than buying it yourself, you get something called a step-up in basis. Instead of inheriting the original owner's low purchase price as your cost basis, your cost basis resets to the property's market value on the date you inherited it. Here's why that matters enormously. Say a parent bought a house decades ago for $80,000, and it's worth $500,000 when they pass away, and you inherit it. If you turn around and sell it soon after for $500,000, your taxable gain isn't $420,000. It's close to zero, because your cost basis stepped up to that $500,000 value the moment you inherited it. On top of that, recent legislation permanently set the federal estate tax exemption at $15 million per person for 2026, meaning the estate itself doesn't owe federal estate tax unless it's worth more than that. For the overwhelming majority of families, that means no federal estate tax is owed at all on an inherited home. The step-up in basis is the real benefit that matters. Let's bring it all together. Property tax funds local services and is based on your home's assessed value. If you itemize, you can deduct property tax and mortgage interest, and as of 2025 and 2026, that SALT deduction cap is dramatically higher than it used to be, up to $40,400 for most filers. When you sell your primary home, the Section 121 exclusion likely protects you from capital gains tax entirely, especially if you've tracked your improvement costs. Rental property plays by different, often more favorable rules, with depreciation and unlimited property tax deductions. And if you inherit property, the step-up in basis usually means far less tax than people expect. None of this replaces a conversation with a real accountant about your specific numbers. Tax law has exceptions for almost everything, and your state may add its own rules on top of federal law. But now you understand the system well enough to ask the right questions instead of guessing. If this helped make sense of something that used to feel confusing, subscribe. We break down one more piece of the credit, debt, legal, and tax system every single week here on Owed. What you owe, what you're owed.